Good morning, and thanks a lot for giving us the opportunity to present this paper. We are very delighted to be doing the program. So this project is a part actually of the broader research agenda, which includes this paper, in which we have a bit of theory and empirical evidence, and we use Dutch data was mentioned yesterday in the keynote speech, the DNB Dutch Household Survey. Then we have another paper, it's a companion paper, so I followed the pattern of some previous presenter, especially yesterday, so I also at the end promote some additional paper of mine. That's quite related to this with some difference, so I would be happy to present some main insights if I have time. So in this project, I mean, we tackled two very important and widely accepted statistics facts. So the first one that was really, like a few seconds ago, that's the dramatic increase in wealth inequality. I don't need to convince you that's an important fact. Just mention here a very recent Oxfam report 2022, but I mean, we can have plenty of pictures uploaded that shows this increase in wealth inequality. And the other side facts is the very limited stock market participation. That's very robust across countries, very consistent across countries. Actually, as we know from standard portfolio theory, all individuals should basically invest in the stock market. Yeah? But surprisingly, the lack of participation, so the very low stock market participation rate is something we observe in the data across many countries. So that's a so-called non-participation factor. These facts are important, especially because they both together matter a lot for economic growth, development, and efficiency. So we need to take care of it. In particular about the first fact, so this dramatic increase in wealth inequality, the recent literature is now basically shifting from trying to explain this fact with heterogeneous return to labor to a more appealing explanation, that's the heterogeneous return to capital. And in particular, recently, they're focusing on these large heterogeneity in individual skills that were also previously mentioned. And I mean, skills is a quite wide meaning. So we can think about genetic endowment, so innate skills, talent, or cognitive abilities and human capital. That's a broad definition. And what we know from the literature is that these skilled individuals, whatever you want to define skills, make better investment decisions. Yeah? So from Calvé, Sogini, we know that they make more proficient portfolio diversification, so they make less investment mistakes. They are more able to manage anxiety when investing in the stock market. They have, I mean, a higher capacity to manage information, to acquire and process information. And then at the end, this recent paper, I will come back to that later on. They have a fantastic data set about biological data. And they show that guys that are more, let's say, more skilled in terms of biological and genetic endowment, they are more prone to risk-taking. These heterogeneity individual skills, at the same time then, it matters a lot because it's able to explain actually both heterogeneity in financial portfolio. As I was mentioning, I mean, these guys are more skilled, are more willing to invest in the stock market and hold a larger share of financial wealth in stocks. And can then at the same time can also work as a kind of alternative channel, alternative rationale to explain this limited stock market participation. I mean, to the many channels that have been proposed so far to explain this non-participation puzzle. And at the same time, again, this heterogeneity individual skill can be also able to explain this heterogeneity in return to wealth. Yeah. So we know that there is a large heterogeneity in return to wealth that will explain a lot about wealth inequality. In particular, they have the different patterns of wealth accumulation over time, which induce a high correlation between the level and the return to wealth. Yeah, that's extremely important. And these skills actually are so important that in this
paper of Fagan, Wisdom, other authors, actually they find that there is no effect of education on return to capital when you condition on unobserved abilities. Yeah, so that's, extremely important also to explain heterogeneity in return to capital so much that education does not have anymore any effect. So what we do in this paper, we want to study the link between these individual skills, so innate, unobserved ability, education, that we mean here for general education, and wealth inequality at the end. Yeah, and of course, this link is extremely broad, right? It's extremely wide, so we want to be very focused and tackle a particular channel. That's the mechanism of the financial investment decision. So what we do in this paper, we present a very simple stylized model that anyway we think is useful to deliver, say that some important insights to deliver the message, and then we provide some empirical evidence using an individual level survey data. That's the Dutch data. So the main takeaway from the model that we go in a few slides is that education, of course, improves the individual investment skills. So think about heterogeneity in individual skills. Then education can improve, let's say, the investment skills. I'll be more clear about that, of the unskilled individuals. And so at the end could prevent these unskilled individuals to make bad investment decisions, closing the gap ultimately between the top and the bottom tail of the wealth distribution. In empirical evidence, we find a beneficial effect of education on wealth and return to wealth due to this particular channel of stock market participation after controlling for this unobserved individual ability. And the main takeaway of this paper is that we want to underline, stress the role of education to alleviate wealth inequality, in particular by promoting the stock market participation of these unskilled individuals. So let me go through the model. We have A, N, and let's start from the agents that are playing this model. So there are N skills heterogeneous individuals. So they are exogenously heterogeneous in terms of skills, of innate abilities, and they have equal endowment. Yeah, that's a simple static model. Yeah. So they start with the same initial wealth, and then after a period they consume a final wealth given by investment payoff plus a public good. Then there is a firm that raises capital through stock issuance to produce an output and distributes after-tax profits to the shareholders. There is a bank that offers a deposit at risk-free rate. Then there is a social plan that we call government that collects the taxes on firm profits, supplies education, and distributes a public good. That matters also efficiency of government, that we've seen in the last part of the model. And the objective of the government is to maximize total welfare that you can think about as a sum of the individual's utility. So these individuals have three investment opportunities. So they can invest in the firm stock, so they will enjoy after-tax dividends. This firm has very simple AK production function, where you see A as a kind of exogenous aggregate productivity state of the economy. They can buy alternatively a lottery ticket that has a strictly negative NPV, and there is the opportunity to invest. To just leave them the money in the bank and get a risk-free rate. So these individuals have heterogeneous beliefs about the probability to win the lottery. Yeah. So let's say the true probability to win the lottery is PI, but they have a bias. Yeah. So described by gamma I, this gamma I is larger than 1. When it is equal to 1, the individual is unbiased. When it's larger than 1, the individual is biased, so it thinks that winning the lottery is more likely than it actually is. And when gamma is very high, that denotes a very unskilled individual. Yeah. That is very biased about this probability. The government then sets and collects taxes on firm profits. So as a twofold trade-off, on one side, when imposed taxes on firm profits reduce, of course, the net firm profits, so the final consumption of the individual, the private consumption. When, however, at the same time, increase the public income, and so can fund education, supply a public good, while education partially corrects, at least partially corrects, the individual bias, so it will basically raise the individual payoff at the end. So that's the sum of individuals, the welfare will increase. Or can distribute a public good and raise the final consumption of the individuals, the final utility. So then the government has to decide how much of the public income has to allocate between education and public good. In terms of education, of course, reduce the money to produce a public good, but increase the final payoff for the individuals because increase the investment payoff by improving the beliefs and the ability to invest correctly. So the timeline, in a couple of slides, at time zero, the individuals are endowed with equal endowment by heterogeneous skills, so heterogeneous ability to assess correctly the probability to win the lottery. The government sets the tax rate on the profits and supplies education. The individuals receive education, update their beliefs. So, hopefully, they improve the ability to see correctly which are the payoff of the investment opportunity, and observe the tax rate, so allocate initial wealth. So the firm raise capital and produce the output, and the bank stores the individual deposit, At time t, the bank returns for the risk-free return to the depositors. The lottery jackpot is awarded to the winner. The firm liquidates after-tax profits, so basically the liquidation value of the firm. The government collects taxes on corporate profits and use tax revenue to finance the public good and education. Individuals receive, collect the payoff from the investments, the public good, and consume the final wealth. So that's basically a two-stage backward solution, right? So the government has to fix an optimal education, say, fraction of public income allocated to education, and an optimal tax rate on the profits. The individual given is delta star, tau star, and their, let's say, endowment of belief. So their skills, they make an optimal allocation. Okay, so the equilibrium is a tripod of a portion of individuals that invest in the stock market, portion of individuals that invest in the lottery, and portion of individuals that just leave the money in the bank. That's here the task is that basically the return of the firm, so basically the stock return, is function of how many people invest, right, in the firm, but how many people invest in the firm is function of the return delivered by the firm. So that's basically a fixed point that we find, numerically. Okay? So now we just show you a few plots. So let's start from the baseline scenario where all the individuals are unbiased, are completely homogeneous. There is no any say belief bias. So then you can interpret the x-axis as state of the economy. So working on the right, that's a better state of the economy, okay? High state of the economy. So there is no one, of course, investing, playing a lottery. That's a negative, strictly negative NPV project. For low state of the economy, people just leave the money in the bank. For high state of the economy, people invest in the stock market. Yeah, that's it. When we introduce skills heterogeneity, so that's a distribution of bias, let's say, in beliefs about the probability to win the lottery, then there is a positive portion of individuals investing, playing the lottery. This is particularly high when the bias is very higher, and it's particularly high when the state of the economy is low. Then moving on the right side, the economy is getting better, so the firm generates more profits, so the proportion of people that still play the lottery will be lower. Then the government comes in. So far there was no government. Then the government comes in, so can impose a tax rate, can collect profits, taxes on profits, and can supply education and public goods. So for low state of the economy, the government does not impose any tax rate because it's too costly to educate the people. Okay? They will not be rewarded. Yeah. So that's something related to a paper of Anna Maria Luzardi that says that sometimes it's too costly for ignorant people to get educated, so it's better to just get out. Okay? So that's what happens basically on the left-hand side. Then for better state of the economy, the government starts to charge a tax rate, becomes, say, profitable to move the individuals toward the stock market. So the blue line is basically the fraction of people that go to the stock market. And this line is the tax rate. Yeah, so that's the dashed lines, that's the education, so that's part of the public income allocated to education. Then the tax rate after, let's say, a peak starts to go down because, of course, for the government, I mean, there's not much need to do then in terms of supply education when the economy is getting better. Yeah, so we can decrease the tax rate anyway people will go to the stock market when the economy will be better. Okay, so there's a big effort at the beginning for the economy in order to push individuals to the stock market and then reduce the taxes. So in terms of welfare analysis, of course the first best is the baseline scenario. Yeah, so that's the solid line. So so that's on the y-axis, the vertical axis, you have the average utility of the individuals. Yeah, so that's the sum, what we call the total welfare. Any difference between the first best and the other lines are what we call the dead weight loss due to bias in beliefs, these low skills. And so that's, I mean, this very, say, severe when there is not the government playing, so that's the dashed line. This dead weight loss is partially recovered by government using education. Then we have the implication in terms of wealth inequality. That there is no inequality, of course, in the baseline scenario. Everyone is the same, so they all do the same choice. Let's say the worst scenario, so the largest inequality, is with the dashed line when there is a bias in the belief that there is no government playing in, and then the government recovers this wealth inequality, so push back this Gini index to zero when so supplies education is able to push the individual to the stock market, avoids this very bad investment decision that's playing a lot. That's a negative MPV project. Let me say a last thing about the model. So far we are just modeling let's say, a neutral government that just collects taxes and distributes public good and or education. We can introduce say, another dimension, that's government efficiency. So basically that's a loading, that's a multiplier of the government that can, say, out of 100 can distribute public good over 100. Yeah, so can let's say generate resources, make a public surplus. Or you have the opposite situation where lambda is lower than 1, where the government basically is wasting resources. So that's inefficient, what we denote inefficient government. Inefficient government, that's the plot on the left-hand side, just raise taxes in order to supply education and to make the individuals make, and to push the individuals to make a better investment decision. Then this tax rate is basically counter-cyclical. Yeah, so for high state of the economy, go down. I mean, however, when the government instead is efficient, then the tax rate is pro-cyclical. Yeah, so even if the individuals are already going anyway to the stock market, the government still push to increase the tax rate because that will be efficient in making a public good, and so will increase the finance individual's utility. So what we do in the MP analysis drawing insight from this model, we use a widely employed survey in House of Finance. That's the Dutch data set, updated up to last year, so that now is 30 years of weights. Those are yearly weights. You have information at the individual household level, and there's a lot of personal characteristics about education, demographic characteristics of many types. You have information about level income and wealth divided into financial and real wealth. And importantly, there are information on financial investments. So you know whether this guy is investing in the stock market, and you also know whether this guy is investing in the stock market by using directly stocks or by using mutual funds share. And we have around 11,000 unique individuals from this panel. So in order to proxy, to measure, to estimate these individual skills, we go back to an approach that like 20 years ago was proposed. So take the log earnings of the individual I tier T, then you regress on a bunch of explanatory variables. Among them, of course, the education and age, gender, and then it's the usual polynomial up to the fourth order. And what you do, very simply, you extract the individual fixed effects. And so we refer to this estimated Fi as this unobserved individual B that you just simply take out from this log earnings regression on the panel data. Now, if you plot the distribution of these individual fixed effects, then what we get, so then from the DHS data. So we didn't know that was something actually reasonable or acceptable. So we went back to this paper, as I mentioned before. This guy is published on the JP and fantastic biological data set. Yeah, that's absolute proprietary. So they have, let's say, data about each guy, how much is let's say, endowed in terms of biological skills. And they provide in their paper a distribution of this biological endowment. So that's a picture just drawn from the paper that, looks quite similar. We have a portion of this guy that is most like unskilled, say, interpreted, so the higher left tail. And not surprisingly, that was also similar to a figure that I saw in a previous presentation. Actually, if I have time, I go to this companion paper using the Italian data, sheet data, we get something very similar. Okay? Then in order to, again, we are still very skeptical about our measure of individual skills. So in order to get a bit more, let's say, confident about it, what we do, we basically replicate the regression analysis of these guys. Bart et al. Take this measure of biological endowment, and then they show that, of course, this is extremely exogenous, so they show that this is highly heterogeneous across individuals, and this positive associated to wealth, so they regress wealth, financial real wealth, onto this measure of biological endowment, and they find that wealth, both financial and real, is positively associated to these skills. Then, we do exactly the same kind of regression analysis. Okay? So we regress total financial real wealth on our measure of skills, and the same set of controls that they have, and we find basically a consistent result. Okay? So when you see that these individual skills are positively associated to wealth, are negatively associated to risk aversion, there is information on the DHS data about a few questions about risk aversion, and positively associated to stock market participation and equity share, so that the share of financial wealth allocated to a stock market. Very simple descriptive evidence. Yeah, so if you use this distribution, you split people according to their estimated individual skills in quartiles, from the unskilled to the skilled. You find monotonic pattern in terms of how much of them is graduated, first of all, then which is the stock market participation rate within quartile of skills, which is the share of the financial wealth allocated to the stock market, and then financial return, and so monotonic pattern in terms of financial return and total return. Okay? So we define total return and financial return simply as wealth growth, total wealth growth and financial wealth growth. We are perfectly aware that this is not the best measure of return to wealth. So in our opinion, a better measure of return to wealth is the one proposed by Anna Maria the recent JP paper. But the problem is that with the DHS data, you don't have information about consumption. So you cannot calculate that measure of return to wealth. So that's the best that we can do here. In the sheet data, there is information about consumption. The Italian data, you can calculate the proper measure of return to wealth. And again, if I have time to show you something about it. But, let's stay with what we have. Okay, sorry, so, financial return and total return are both monetarily associated with this skills quartile. So then, in order to measure the the effect of education on the top of this individual observability through the channel of stock market participation on a set, say different set of variables, then we use this simultaneous two-equation model. So you have a main regression, a main equation. There is a dependent variable y. We use both wealth and wealth growth, so return to wealth. And in the main equation, you have stock market participation. That's the I, that's the dummy, 1-0 for investing in the stock market. You have education, you have this measure of individual skills, then the bunch of control, and the likely wealth. In the auxiliary regression, that's the 7-1. Then the dependent variable becomes the stock market participation dummy. And then you have the same bunch of controls, the same set of independent variables. So there you can measure basically the direct effect of education, that's beta 2. The indirect effect, that's the product between the effect of education on stock market participation times the effect of stock market participation on the dependent variable. And then the total effect, that's the sum of direct and indirect effect. So the first panel A refers to the equation, to the main equation, then panel B to the auxiliary equation. So I just underline with red and blue, well, basically here you have with red and blue, so indirect and direct effect. So that's the direct effect of stock market participation, of course, to be positive, and the positive and direct effect of education, that's the blue. So that's significant only for the level, so wealth, total wealth, financial wealth, is not significant for wealth growth and financial wealth growth. Instead, I mean, education has a positive impact of stock market participation, as we know very well, and stock market participation itself has a positive effect on both level and return to wealth. Yeah. So the blue one is the direct channel. That is not significant actually, as we already knew from when in condition, particularly condition on these skills, we already knew from other papers I mentioned it before. But is highly significant the indirect effect of education through the stock market participation. You can easily quantify, right? So that's you can just easily get out the numbers of direct and indirect effect. That's basically 0 on financial return. That's basically 0.4% of annual financial return. More than the highly educated people get compared to the less educated people. In terms of total wealth, that's 0.2% of annual extra return of highly educated people. So that's the economic meaning. These are annual data, so annual financial real wealth growth, so you can easily quantify economically this effect. Then we have a set of additional results to better understand what's going on. So we exclude, for instance, the COVID-19. So basically we stop the data at 2019, and this does not change at all the results. Then we omit individual skills, for instance, in this estimated model, and of course, not surprisingly, the effect of education is much larger, because it includes absorb these omitted unobserved abilities. I didn't mention what means actually highly educated people here in this DHS data set. We include, for the particular system of education system of Netherlands, we include both people that are graduate from the university and people that go to vocational training. But that's a broad, wide definition of highly educated. So we then, in a let's say kind of robustness check, we exclude people that are just vocational training, and we only include in the sample of highly educated people that are graduate from the university in a strict sense. That we find that the results are pretty robust. That means that the university, so the higher education, drives these results. That's what just point out on this last point in my table. That's an important difference between investing in the stock market using direct stock holding or mutual fund share. So what we find that if you can design triangle, so by estimating the same set of equations using only that there is different variables in the data set, so different dynamic described with this choice. So when you look at direct stockholding, then even the indirect effect of education, for example, total return disappear, and the indirect effect of education financial return is half of what we saw before. While this becomes much stronger when we use mutual fund share. Yeah, so that's what the kind of mechanism highly educated people, highly educated individuals resort to portfolio diversification rather than so using mutual fund share rather than investing with just stock directly. So that's all for this paper. So let me just show something of this companion papers. I was mentioning, these few. That's what I'm happy that it was also mentioned in the keynote speech. Yes, that's our Italian data set. That's a SHIP, where a very important difference compared to the Dutch data set is that there are information on saving and consumption. So you can calculate properly return to wealth. So that's the formula, very simple formula to calculate return to wealth. So you need to take into account, of course, either saving or consumption spending. So if you, just sort here individuals based on the initial wealth, so on the level of wealth, that's what we know from the literature. Yeah? That's the correlation between level and return to wealth. So richer individuals also get higher return to wealth. So just going a quick reason of time, that's something that's the distribution of these skills in the Italian data set. That is quite comparable to the Dutch one. Then again, we use the same set, say, the same set of regression, and again, we get very similar results in this SHIP data set. So what we can do in the SHIP data set compared to what we can do in the Dutch data set, for instance, is to look at different degrees. Different topics, different measures that people get. And for instance, in terms of stock market participation in particular, we find that the only field that makes you an advantage compared to the other is a major in economics. Yeah. So that's a great difference compared to the other fields. Then we tackle these two economic mechanisms. One is portfolio diversification, so that the choice between stock markets using stock directly and mutual fund share. And the other one is ownership persistence, so basically how much you stay on the market, participation frequency, and how much you rebalance. So that goes back to the channel of anxiety control. Yeah, so you stay on the market longer, you don't just go and in and out depending on how it's going to market. Okay, so that's at the end rewards. And that's it. I want to take, this is just to underline this mechanism. Yeah, so in this paper and wrote in this project, we want to understand whether education has the ability to alleviate wealth inequality by pushing them into these skilled individuals that otherwise would generate large wealth inequality to make better investment decisions. And so that's the main result is the beneficial effect of education conditional on individual abilities through the particular channel of stock market participation and eventually asset allocation. Thank you very much for your attention.
I'm Michael. I'm at the Bank of Canada. You were just going to reply to my views, not those of the Bank of Canada or the governor. So one slide summary of this paper. The question that the authors are trying to get at is what is the link between individual skills, education as kind of a mediator, and then wealth inequality via this financial investment decision channel. So I think that's a really nice question. It's trying to understand how much of wealth inequality, which is obviously an important topic, can we explain by the fact that people are making different investments. What they do in this paper is two things. First, they build a structural model of investors who have the same initial endowment, but that there's different ability to evaluate the same set of financial products, therefore make different decisions. And then you have a social planner who can modify the distribution of ability to evaluate things by modifying the distribution of education, for example. The second part of the paper is this empirical analysis, which they use the Dutch household survey, and I think that's really where most of the paper is, and they do a lot of really neat analysis at this decomposition of different effects, and we'll talk about that more in a few slides. So the two main findings in my view are that the skilled individuals, right, the way that they estimate, it's kind of the residual when we can explain the things we can observe, is that they have a higher propensity for investing in the stock market and risk taking, and then there's this positive match between ability and returns. And then what I think is really neat is that they separate the direct and indirect effects of education, and then they document that the impact of education really does matter, but primarily through this decision to actually participate in the stock market. So that's kind of one of the two main findings. The second one in particular is really important to me. Now for me, when I was first reading this paper, and I think the presentation was a bit different than the paper itself, I thought about, how would I frame this? What's kind of the motivation, and what's the contribution of this paper? So the broad question is, what is the source of conditional wealth inequality? So if we have two people who start off very differently, that's one thing. But let's say we have two people who start off exactly the same, and then what causes them to deviate from each other with respect to wealth over their life cycles? And this paper focuses on this really neat financial investment decision channel, okay? And really the motivating factor for me is that if you look at people who presumably have access to kind of the same instruments, there's this massive heterogeneity in the returns that they get on their investments. So there's this one paper that uses other European data in Norway, Fegering, Guizzo, Malacrino, and Cristoferi, and the standard deviation for average returns is 22.1 percentage points. So that's a huge, huge number. And even after 1, 2, 3, let alone the life cycle, you're going to have such different returns just from having different investments. So this begs the question, what drives this huge heterogeneity? And in my view, there's kind of two main things you can think about. This paper is really on the first one, which is you have these heterogeneous individual skills. Some people are perhaps educated differently, and they can pick better returns. And the second angle that this paper doesn't cover, but I think you can do more citations and think more about this, is that there are different opportunities to invest, right? And the paper that I cited above talks about this a bit, is that some people, perhaps because of the families they're born into, perhaps because of their education, perhaps simply where they live, have access to different instruments. But this paper really focuses on the first one, and they find that this individual skill is very, very important, right? It's a similar result, and it kind of is consistent with the Fegering paper, and then it kind of takes it a step further and says, well, we can fix some of that, right? We have this distribution of people who invest differently. A lot of that could be because they don't know any better. So there's a role here for policy. There's some kind of inefficiency in the market, and the government can fix that, especially through this education channel. In this paper, they actually don't look at necessarily education in finance or economics. So the Fegering paper, the way they look at sophistication is if your degree is in finance or economics. This paper is even more broad. If you have education, then you're going to have better investments. And that's actually interesting because education might be a proxy for ability, it might be a proxy for curiosity, intellectual ability, so all these things, but here just the idea of being educated, having a university degree, or having some other level of education can kind of fix some of this. So I think it's really interesting, it's a nice paper. It's relatively early, so I have some bigger comments, some specific things. Really nice thorough empirical analysis, right? They use the Dutch household survey, and I think the main exercise was decomposing the direct and indirect effects of education and skills. There are a lot of results, and if you read through the results section, in my view, is a little bit dense, and you have tables 3 to 7 are the main results, and then you have another 5 or 6 tables for the appendix results. So even in the presentation, I think it was nice to have the numbers, but I would suggest visualize some of the data, and I think it drives home the points even more. So this is table 3 from the paper, and we saw some of these numbers during the presentation. So panel A is the kind of baseline summary stats, and I thought just plotting it, right, would be a really nice way to show there's quite a bit of variation. So here what the author, I'm using the author's numbers, and I hope you notice that I have the new data. The bank already updated our licenses. These are the new default colors. So I've plotted here kind of unskilled, which is the lower quartile, 25th to 50th, 50th to 75th, and skilled. And I think it really pops, right? Here you can see that there's quite a bit of variation in college share, equity share, and market share on the left, and then financial and total returns on the right. So this is a really nice way for me to visualize and see, okay, college share is actually, it's pretty high in general, especially for the skilled people. And then you can even kind of normalize this by the skilled group. And then this really shows you how there is quite a bit of difference, especially from the unskilled all the way to skilled. But even across the middle 2 quartiles, there's quite a bit of variation, which I think is very nice. And one way the authors can visualize this and really drive home the point that there is a lot of variation in data, and they can exploit that in their analysis. Even taking this one step further, I think this kind of data really lends itself well to these radar figures. So here, I've drawn this figure, And the outer layer, the yellow line, is the skilled people. So they're normalized to 1 or 100%. And then the 5 points are college share, total return, market share, financial return, and equity share. And you can see that, you know, the 50 to 75th is actually not too far from the skilled people, but especially as you get to the unskilled, they are very different. This is just another way I thought it would be nice to visualize some of the descriptive stats and really kind of help the reader understand that there's a lot of variation that maybe doesn't come out as much if you just look at the raw numbers. Now, for the main kind of empirical regression results, I thought table 7 was the main table, and then there's robustness in the following tables. And again, here I thought it would be nice to visualize, you know, what are the contribution of education and skills and the differences across these different variables, and then you can further decompose that into, for each of these, a direct effect and indirect effect. And again, here it's really nice. You can see actually that for financial returns and total returns, this direct effect is important, but the indirect effect is also very important. And then if you look at financial wealth and total wealth, it's a bit of the opposite story, where the direct effect is really driving things, but the indirect effect is also still not as important, but not negligible either. It does have a meaningful contribution, and I just think these kind of figures really help the reader kind of go through and understand the paper a bit better. Now, finally, you know, my main comment was about the model. So for this type of analysis, I think the model can do one of or two things, right? First, it can help kind of unpack complex and interactive mechanisms. It's very difficult to think through the life cycle in your head. That's why we write down models, right? We have all this math that helps us write down, and as one of my co-authors loves to say, is you talk enough to your model, and eventually it talks back to you. So it helps you understand what's going on, and you can also generate these empirical predictions that you can test in the data. The second thing you can do is then use your model as a laboratory in which you perform different experiments and especially counterfactual analysis. So this paper is firmly in number 1. And they write kind of at the end of the model section, the key model prediction is that education improves both the level and returns to wealth by increasing the individual's propensity to invest in the stock market thanks to a better ability to evaluate investment payoffs, conditional on heterogeneous individual skills. And then we don't hear about the model again. So my point with this was that I think it's a nice model. I think it is kind of intuitive, but for me, the goal was number 1, but I think this is relatively intuitive, right? I don't think that anyone here as prior would have been different than this statement. So the model lays out all this intuition and it shows you what you can kind of get in the model, and then we don't do any of number 2. We don't really take the model any further. So my suggestion would be to use the model as a simple laboratory to explore some counterfactual analysis, right? So I think there's going to be, I have a suggestion of what you can do, but I think there will be challenges as well. So in the model, there's this distribution of heterogeneity, and it lends itself well, and I think that's actually what motivates the estimation of the distribution of unobserved skill. So you can try to calibrate the distribution of heterogeneity in the model to match, in some sense, the distribution of heterogeneity that you see in the data. And then you can calculate the relative welfare gains in the model of the government policy, for example. You can also run other counterfactuals. You can say, okay, well, imagine there is no government, and there was just no heterogeneity in general. How much welfare is the heterogeneity costing people? And then you can figure out how much would it cost the government to implement some program, and you can analyze the cost and benefit of such program. That's what the model helps you to do. I want to note, currently in the model, they have some welfare analysis. The welfare analysis plots average utility, which is typically not something that we do because utility is typically ordinal, not cardinal, and therefore I would recommend to convert the welfare to consumption equivalent measures. But I think in general, that's where I would try to take this paper, is I would use the model more than it's currently used to do some more analysis. So the challenge with that is that, you know, this model is really nice, and as we saw, they plotted a bunch of really neat figures, and that's because everything is in closed form. So if you work with these models, you know, closed form is kind of the mecca. It's the gold standard of trying to make your model make sense, but you have to make certain decisions. And the decisions they make are important ones that in this case I think are actually taking quite a bit of bite out of what we can learn from the model, right? So one of the big decisions that they make is that they have to have risk-neutral investors, and that gives you nice linearity. But is that something that we think is realistic here, right? Do we really think that people are risk-neutral, especially if you're thinking about making decisions and investments? In the model, they call it lotteries, but it's like investments, but still, we typically don't think that people are going to be risk-neutral with that. The other thing that they have in the model is there's this key parameter that governs the efficiency of the model, right? Like if you're used to macro models, government spending can either be helpful for people or it can be completely useless, but it costs people things. Now, this efficiency of government, the way they model it, is very difficult to conceptualize and then calibrate, and I'm not actually sure that it's going to be very helpful. It doesn't seem to me like it's going to be necessary for analysis. So the point I want to make is that the model is really nice to think through what's going on, but I think that absent the model, we could have arrived at many of the similar conclusions. So the model to me is a good way to take some of the data, feed it back into the model, and then run different experiments. So I think that that's possible with the model. You might have to make some changes. You might lose some of the closed form niceness that you have, but I think that would be necessary for me to look at this and say, yeah, the model is really serving a purpose here in addition to the great empirical work. So let me stop here. Thank you for the opportunity to read the paper. I think it's a really nice paper. I think I actually learned something, and my takeaway from it is that, yeah, wealth inequality happens because people make different investment decisions. You can fix some of that by educating people, by kind of the theme of this session was financial literacy. If you help people become more financially literate, they'll make more equal financial decisions, and then inequality will go down. So thank you for your time.
I will send you all my papers before presenting, and then you will tell me how to present. That's very nice. We didn't think about it. So I will share that with my posters. And we will have the next presentation of this paper next week. I will present it this way. I will send you an updated set of slides. Sometimes we really focus on getting results, but then we don't take out the way to sell it better. So thanks a lot for the suggestion. All are extremely nice. So we'll use for sure. Just a couple of things. And that's very useful comments. And I totally agree with all your comments, and also with the weakness of the paper, of the step between model and empirialize that you underline. You are actually, in my opinion, too kind in saying that we use a structural model. For some other work, I try to do structural estimation, and I will never cite this model as a structural model. Because as you said, we don't use the model to we don't take the model to the data. Yeah, that's the main fact so far. So I wouldn't mark, I wouldn't label as a structural model because we don't take it really to the data. We developed this model. We try to convey a message in a very simple way, and then in order to make, let's say, smoother the results, more understandable the importance of the results in the empirical analysis. But you made a very nice suggestion about how to take the model to the data, and that's something I will actually do. I will try to do. You're right about efficiency. That's not key to deliver the message. We use it because at the beginning we want to try also to describe a bit of heterogeneity across countries. Yeah? So think about Italy and Sweden in terms of efficiency of the government. So that lambda could describe this heterogeneity across countries. But since at the moment we use, as an empirical, only the Dutch data, you're right that does not really matter for the main message of the paper. But we will follow your suggestion to make the model more useful to interpret this empirical idea. Thanks a lot. Thank you very much.
Can you tell a bit more about your identification assumption in your two-system equation? Because my understanding is that you assume that contemporaneous stock market affects contemporaneous wealth, but contemporaneous wealth does not affect stock market. Is this correct? First of all, and is this a good assumption?
Yes, exactly. Absolutely yes. And we of course in the main equation we control also for the lagged.
I want to know about whether this is a good assumption or not, and whether you thought about this assumption.
So the problem is that of course that we have evidence that rich people invest more in the stock market. Right?
Think about the lottery, because yesterday we discussed. So think about in 2023 you received, you know, some lottery prize, and you might invest something in the stock market. So this sort of is a violation of your identification assumption, because in this year you had a shock and you go to the stock market and you spend part of it, right?
So, but I mean, let me maybe make things more precise. So when you have information about the stock market participation, that refers to the previous waves, right? So in the previous year, whether you had invested in stock market. So then we use that lagged stock market participation.
Yeah, but wealth is measured at the beginning of the period. So,
Yeah.
So with that,
So yeah, the lagged stock market participation and the contemporaneous wealth.
okay, we can discuss this over lunch. I don't want to.
No, I mean there is no
Okay,
contemporaneous.
but anyway, you have an identification assumption, because otherwise you cannot talk about direct and indirect effects. So in general, I think what we need to motivate a bit why you close this link, which for many people is very natural, that the more wealth you have, the more likely you are to invest in stocks, because expected gain is higher and so forth. But okay.
Yeah, I mean, I absolutely agree with you. Maybe Ian explained very well, but I mean, the stock market participation is one period lagged with respect to the time in which it's measured well.
Okay.
Any other questions? No? Everyone's hungry for lunch? Good. Okay, so thank you so much.